$120 billion in buybacks. Meanwhile, Nvidia's cutting R&D headcount. Here's what that gap means for your retirement portfolio and why the market hasn't repriced it yet. If you're holding Nvidia as a growth anchor or dividend play, especially if you're within 10 years of retirement, this pattern matters more than you think. A household with $200,000 in Nvidia could face $30,000 to $50,000. 000 loss if R&D reductions signal a competitive slowdown that earnings misses won't hide forever. Let's walk through the numbers, then I'll show you exactly how to read the 10K footnotes to catch this before CNBC reprices the stock. ***, the wrong belief you're probably holding ***, when a company announces a massive $120 billion stock buyback. The narrative is always the same. Management is confident. The stock is undervalued. Executives are putting their money where their mouth is. This is what you hear on CNBC. This is the bullish signal. But here's the reality hiding in the earnings call transcripts. The R&D headcount cut. Nobody's talking about *** in Nvidia's Q4 2024 earnings call and the accompanying 10K filing. R&D headcount reductions appear, not in the press release, but buried in the detailed expense footnotes and management discussion sections. This is textbook financial engineering. Spend $120 billion buying back shares to support the stock price while cutting the exact spending category that drives future growth. Why? Because buybacks show immediate earnings per share accretion. Cutting 500 or 1,000 R&D headcount cuts doesn't immediately hurt the headline number, it just makes the cost structure leaner. Wall Street loves this, until it doesn't. *** historical proof. Intel's playbook ***. Look at Intel in 2018-2020. Intel authorized a $25 billion buyback program while gradually reducing R&D headcount and slowing product cycle investments. The stock held steady. Then in 2021-2023, Intel's chip delays and competitive losses to TSMC crushed the stock from $60 to $25, 58% loss. Why? Because the R&D cuts in 2019 meant no pipeline to compete by 2023. The 10K footnotes from 2019 showed the warning sign, but most investors never read them. IBM did the same thing in the 2000s. Massive buybacks, quiet R&D reduction, and then a decade-long earnings miss cycle. ***, what this means for your Nvidia position. ***, Nvidia's competitive moat is real, but it's only as durable as the next generation of chips. If R&D headcount is down while design complexity is up, the timeline stretches. Missed product windows create openings for AMD, Broadcom, or custom silicon from cloud providers. A single missed cycle costs Nvidia billions in market share. For a household holding $200,000 in Nvidia, typical for dividend portfolios or high net worth core holdings, a 15-25% correction equals $30,000 to $50,000 in unrealized losses. For someone 5 years from retirement, that's not recoverable within your working years. ***, how to read the 10K yourself. ***, open Nvidia's FY 2024 10K. Go to the research and development expense line in the consolidated statements of income. Compare it to FY 2023, check the absolute dollar figure and the percentage of revenue, then go to the MD in a section and search for headcount or workforce. Most companies bury this, but it's there. Compare Nvidia's R&D percentage to peers, Broadcom, AMD, Qualcomm. If Nvidia's R&D spending fell as a percentage of revenue while other peers maintained or increased it, you've spotted the divergence. ***, the 3 questions to ask right now. ***. First, what percentage of your portfolio is Nvidia? If it's above 15-20%, you're facing concentration risk regardless of the buyback. Second, are you relying on Nvidia for dividend income or growth capital? Pre-retirees need stability. Buyback aggression plus R&D cut signals volatility ahead. Third, when was the last time you audited your holdings against 10K footnotes, not just headline earnings? ***, the delta. If you hold Nvidia based on the confident buyback narrative, you're exposed to a 15-25% correction over 18-24 months if product cycles slip. That's $30,000, $50,000 on a $200K position. Meanwhile, if you had repositioned even 30-40% of that into diversified tech or stable dividend funds, your downside would be capped at $10,000, $15,000 while maintaining growth exposure elsewhere. The choice is yours, but the pattern is visible in the 10K right now, if you know where to look. For the full math on tech concentration risk and how to audit your own 10K holdings, check the companion book, The MSTR Bitcoin Trick, link in the description. In strategy, the quiet observer wins.